Well, folks, 4 years have flown by, and we're in another election season. The news cycle is pretty inescapable and overwhelming. And politics aside, I'm sure you're also thinking about what could this mean for the economy, for my investment portfolio, and I'm here to try to answer that today. So, taking a look at our agenda, first we're going to talk about the anxiety that comes with with election years regarding investing. We're going to look at the historical data. Then we're going to think critically about why do we observe that data, and then we're going to talk about what to do with that information. So, without further ado, uh, election years tend to lead to some anxiety. It's not uncommon for people to be worried about what's going to happen in an election year. It took me less than a minute to find an applicable cartoon for this slide. The uncertainty can lead to a lot of anxiety, nervousness. So understand that you're not alone if you're feeling that. And to make it worse, the media feeds that anxiety. These are headlines from the past few weeks that I grabbed that prey on that uncertainty, trying to get clicks. We read things like U.S. election is just one risk among many for nervous stock market. The next 2 months could be bad for the stock markets. Here's why. The media is always trying to get us um, to fear, and because that results in more attention paid to them, and that's their business model. So understand that if you read a lot of scary headlines, that there's an ulterior motive there. Looking at the data to support this idea that anxiety spikes around the election regarding investment portfolios, these are the Google Trend results for the combination of stock market and election. And it spikes every election season. So we see spikes every couple of years in November, and particularly larger spikes around presidential elections. I expect our 2024 spike to rival 2020's in the next month or so. Okay, now that we've sort of outlined that it can be worrying to think about the election in our portfolios, let's take a look at the actual data on election outcomes, political regimes, and investing. And just to spoil it, the historical data is very clear. Election outcomes do not dictate market success. So let's take a look at the first graphic here. What I'm showing is a histogram of monthly returns to the S&P 500 index for approximately 100 years. The colors blue and red indicate a month where where that particular party won an election and what was the associated return to the market in that month. And what do we see here? Frankly, we see nothing. We see nothing usable here. It doesn't seem to matter to the market whether or not Republicans or Democrats win. The results have been similar to the general monthly return data over the long run. How about if we think about investing during different political regimes? Well, this one looks at Republican versus Democrat presidents, and what we notice here is that the S&P 500 or the stock market has tended to rise regardless of which party is in the White House. So that doesn't seem to play a role in investment success. And if we look at the same graphic but switch the colors to Congress, whether Democrat, Republican, or mixed, we see a similar result. Not much of an impact depending on who tends to be in power. Markets tend to go up over time. What else has been studied? Well, do certain sectors tend to perform better under different parties? The answer tends to be no. What if you moved your portfolio to cash each presidential election year? If you have done that historically, you would have done worse. How about if you only invested when one party was in control of the White House or Congress? The answer to both of those is also you would do worse than a simple buy and hold. And then do the results change if incumbents win the election versus challengers? Again, no discernible pattern there either. So all of these questions lead to the same place, which is markets tend to be apolitical. The last question here is kind of interesting to me. How does volatility evolve during an election year? We do observe an increase in volatility in the month or two leading up to the election, but then that volatility tends to come back down after the election results are known. That's a historical pattern that we do observe. There's nothing that we should do about it, though, because everyone knows about it and it's already priced into the market. So, nothing to do with it except understand and recognize that perhaps stocks will be bouncing around a little bit more than usual over the next several weeks. Okay, so like I stated, markets look like they're apolitical to us. And any kind of movement associated with a political outcome tends to be short term noise. And what we're focused on is long term growth. So we can put politics aside and remain invested because we know what the long run holds. So I think a more interesting question than what has happened is why do we see these results and what should we do about it? And I'm going to try to answer that in the next few slides here. So let's start from first principles, and that is that earnings power stock returns. In the graphic, bars represent earnings per share of the S&P 500, and the line is the level of the S&P 500. So as the economy grows and businesses generate profits, stocks tend to go up. Every single company is composed of people, and people work together to try to solve problems and become more efficient, do more with less, and they always adapt to the current environment. Whatever happens in the election this year, people are going to adapt to it, and I believe that they will adapt to profitably deliver goods and services. And it might not be a straight line. Of course, we see jagged edges here when uncertainty rises and people get scared and earnings fall. But the general direction is up and to the right, and I believe that will continue to be the case. Putting more fuel on that fire, I think long-term optimism should be the default setting for all of us as investors. And what I'm showing here is the last 200 years of data of global GDP. It's increased about 100 times in the last 200 years. Just phenomenal progress. Tons and tons of people have exited poverty. We tend to progress as a society over time. So as we think about being an investor and being invested for the long term, optimism should be our default setting. So, what do we do with this information? The information that historically markets have not really reacted to political outcomes in any meaningful or consistent way. And when we know that what drives returns is earnings, and what creates earnings is people solving problems and moving forward, what do we do? Well, first thing we do is we diversify. We don't know, perhaps a particular sector or country may have disproportionate impacts based on some political outcome. And so we don't want to be subject to that idiosyncratic risk. So we own as much of the market as we can. And I put in this table a comparison to some common investment choices that I see people make. One is the NASDAQ 100. This is represented or often invested in through the QQQ ETF. It holds about 100 stocks. It's 100% US focused, and the sector weights are proportional to those 100 stocks, which tends to be very heavily weighted towards technology. So the NASDAQ 100, while it holds 100 names, it's very concentrated geographically in the US and in the technology sector in particular. Next, moving to a little bit more diversification, the S&P 500 holds about 500 stocks. However, it's also 100% U.S. based. So you've got some geographic concentration, and again, the sector weights are proportional to those 500 stocks, which tends to overweight particular sectors that are more important in the U.S. than they are more broadly. Now, finally, the Secfi portfolio that we manage on behalf of our clients, at least the equity portion, we tend to own the underlying investments own about 10,000 stocks across the world. across 42 different countries, both developed and emerging. And our sector weights are driven by company or stock characteristics that we believe both increase expected returns of the portfolio and are good risk management um, uh, factors for folks that are equity compensated. So that is our level of diversification. It's much higher than you would get in just an S&P 500 style index portfolio, or the Nasdaq 100. So we diversify, and we diversify very broadly. What else do we do, or what don't we do more precisely? We don't react. To illustrate why, I've plotted here on the right hand side in the graphic the performance of the S&P 500 from 1990 to 2023. If you had invested $1,000 at the beginning, what would your ending wealth be if you just held it? That's in this total period column. How about if you missed the single best day of the S&P 500 over that 33-year period? The 5 best days, the 15 and 25 best days. And of course, if you miss the best return day, your wealth is going to be lower. But what I think is striking is how much lower your wealth is if you miss a single best day, or just 5 days in 33 years, or 15 or 25. The impact is really big because the power of compounding is so large. So, vice versa, if you miss the worst day, the chart would go the other way. But we can't predict when those best days or worst days will occur. It makes much more sense to stay invested, given the historical data we've seen and the reason why we've seen it. Stick to your portfolio. So what can we do? We can control what we can control. We try not to worry too much about what the market will do. The market's going to do what the market's going to do. But there's a whole host of things that we can control that can impact our investment outcomes to a great degree over the long run. And, we focus on all of these ones here. The one that you can focus on as well is your own behavior. So think about, what the historical data tells us, why it says that, and hopefully that can, ease some of your anxiety and keep you from making some of these investment mistakes that sometimes folks make emotionally when they're reacting to a political outcome. So in conclusion, elections are always going to create uncertainty and anxiety, but hopefully the data and the reason why we see the data can help calm that anxiety for you. We shouldn't react to that stuff. We can be long-term optimists because of the dynamism of humanity, to boil it down to first principles. And when you're well diversified, controlling what you can control, the odds have been put in your favor, and there's really no need to react or do anything different in an election year versus a non-election year. So hopefully this little presentation helps calm the nerves a little bit going into this election season. But if you want to talk further about your portfolio or about how we invest in general, my door is always open. Please drop me a line. Happy to chat. Hopefully this was helpful. Talk to y'all later.